negative cash flow. The two words in investing that most people hate to hear. I'll be explaining to you why negative cash flow is not necessarily bad, and most importantly, it's not equivalent to what most people think is negative income. Remember this, negative cash flow is not equals to negative income. Positive cash flow is great but may not be always achievable depending on the market that you're investing in. So in this video, I'll be sharing with you why negative cash flow is not the same as negative income, and also two specific scenarios where negative cash flow is something okay to live with. Keep watching. Straight to our first point, to explain why negative cash flow is not the same as negative income. We will use an example of a $1 million property with a 75% loan, 2% interest rate, and a 30-year repayment period. Using an online calculator, your repayment per month to the bank would be about $2.77 thousand per month. This is where most people have a misconception, because moving on, let's say you are renting your property at 2.6k per month. Most people would just look at it as 2.77 is greater than 2.6k. Therefore, it's a negative cash flow, which equals to bad investment. Yes, that's probably what we learned and maybe what our parents taught us as well. However, let's look at it more carefully. Remember the numbers we have here? Your repayment is 2.77k per month. I want to explain to you that this 2,700 per month mortgage payment is actually split into two components. The first is your expenses, or to be more specific, interest expenses. Who earns this? It's paid to the bank. Okay? And there's a second portion of it, which is your principal payment, also known as equity. Okay? Expenses is your cost of the financing. You're basically like throwing the money down the drain. Principal, on the other hand, is paid to yourself and stored up as equity within your home. When you look at it this way, your expenses is broken down into about $1,250 and your equity is about $1,522. This totals your monthly mortgage, which is about $2,770 per month. If you notice your rental now, let's look back at the figures. Your rental now is 2.6k per month. This is known as your rental income. Your rental income. Alright? From an accounting standpoint, your income, your net income, is income minus expenses. Therefore, your income would be the rental income that I mentioned earlier at 2.6 thousand minus your interest expense, which is 1,250, which will give you an income of about 1,350 per month. This, despite you are experiencing a negative cash flow of, let's look at the earlier chart, negative cash flow difference between 2.77 and 2.6, which is about $170 per month. And there you go. And in fact, This is how IRAs computes it as well, because if you realize, if you have investment properties and you are experiencing negative cash flows, you still get the rental income charged in your income tax statement. And I say again, this equity portion principle goes towards paying down the loan so that one day when you do sell your property, you get back this amount of money. Moving on then, in what scenarios is it okay to have negative cash flows for your investment property? Number one, when you are looking for capital appreciation. And number two, where you are in it for the long-term gain. Let's explore each of these options more in depth. Capital appreciation, in the context of Singapore, it's like an investment in projects, BUC, building under construction, or more commonly known as new launches. So what happens when you buy into such projects with the objective of capital appreciation? In the Singapore context, you are not able to rent the property or earn any income whatsoever from it. Of course, it's still being built. During this period of time, you do pay your mortgage repayments, however, progressively. So let's say over a 5-year building period. In year 1, year 2, year 3, year 4, and year 5. Okay? In year 1, your repayments may be about 300 per month. Year 2, maybe 600 per month. Year 3, 1,500 per month. And when you receive the keys, maybe about 2.5k per month. All these are your negative cash flows. However, because it's a new launch property, there is a chance of achieving that TOP effect where the property goes up by about 20 to 30% upon its completion, potentially. I explain more about this TOP effect using a case study at Clement Canopy. Click the link above to watch that video. Another play for short-term capital appreciation is via resale properties. In this case, you'll be looking for either fire sales or under the radar, undervalued properties. For resale properties, when you're gunning for capital appreciation, you need to make sure that you're entering at below market price in order for the negative cash flow to make sense for you in the short run. That's for capital appreciation. What I personally go for and also advocate my clients to go for is a more safety first approach with a long-term view, because after all, real estate is a long-term asset. So I usually go for the second one, which is long-term gain. Long-term gain is really about picking the right investments, because over the long run, as you pay down your loan, your equity component in the property would just keep going up while your loan component would just keep falling and falling until it reaches zero. At the end, this is the amount that you have earned. Did you know that using the earlier 1 million property example, assuming the mortgage is a 30-year mortgage, after 30 years, your total outflow, total negative cash flow, to make it clearer, as that's the topic of the video, is 500,000. Even if at that point of time, somehow your property did not appreciate at all, which means your property value at 30 years is still the same as you bought, which is 1 mil, fully paid, it means that when you sell that property, you take back $1 million that you only used 500,000 to earn. That's double up with your money after 30 years. I'm Jim Tay, a professional real estate consultant in Singapore, and I focus on long-term retirement planning for my clients. If you want to learn more about this topic, I would like to share an ebook that I wrote especially for you. Just click the link in the description below and it'll lead you to a site where you can download your free ebook. I hope you enjoyed this video. Let me know if you have any questions on the concepts that I've shared in the comments below. Share it with your friends if you find it useful. Remember to subscribe, and I'll see you in my next video.